Yo guys, it's John here with Option Lab. In this video, I'm going to be giving you an in-depth breakdown of how I would trade a 50K account with option selling. Not only am I going to break down what I mean by selling options, I'm also going to explain how these strategies beat buy and hold, how to allocate this $50,000 across the different strategies I'm about to explain, how to trade the wheel strategy on a 50K account, which is one of my favorites, and then how to supplement this income with spreads and condors that require very little buying power. This is one you're definitely going to want to lock in for. I think that this is probably one of my more valuable videos if you guys do pay close attention. So if you guys are not familiar with who I am, my name is John. I'm the owner of Option Lab. I did roughly 2.2 million in 2024. I will show you guys my live account right here. You can see this is last year in this account. So I don't want to get any bullshit comments saying this is a fake account, blah, blah, blah. Anyway, if you guys do want to learn more about the strategies I'm about to explain and want to get the cheat sheet that I made specifically for the strategies I'm about to explain, click the link in the description and pop your email in right here. I'm going to send you guys for free my option selling cheat sheet. Okay, so let's get into the video. So the first thing I want to cover is what do I actually mean by selling options? And let me make sure you guys can see this clearly. Yeah, that should be good. Okay, so normally we talk about buying options, right? So we're making a prediction that XYZ stock is going to go to this price. You buy a call option, blah, 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 blah. And typically, and statistically speaking, buying options is a pretty low probability trade. But in turn, that makes selling options an actually very high probability trade. So when you're selling options, or what we would call here the option writer, you collect the premium or you get paid up front for taking on the trade. So you're selling to open, for example, a put option, and for doing so, you're collecting a premium. You therefore then have an obligation. If exercised, you must buy the stock in the case that a cash secured put would then be assigned, or sell, in other words, be short the stock if your short call is assigned. There is a very much so a higher probability of profit since most options expire worthless, so that the seller actually has a statistical edge. A lot of the trades I'm taking have 70% plus probability of success. So I'm going to explain that kind of like over in this part of the video, but let's keep going. Next thing, they're limited risk, limited reward. And you are getting a max profit. So if we contrast it with buying options where there's essentially an unlimited upside, with selling options, you are getting a higher probability, but you are also getting a max profit. The downside can be large in the case that if you were to be assigned a short put and that stock were to continue to crater, you'd not only be having to put out quite a bit of buying power, but you'd be then incurring a loss on those shares. So the last thing, which is huge, right? This is the real bread and butter of why this is such a great strategy, is time decay works in your favor. So each day that option is going to lose value due to theta, which is helping you essentially make more money or collect that premium and not have to buy shares because that stock is staying above your strike price, and then theta is decaying the value of it. So let's actually look at an example here so you guys have an understanding of what I'm actually talking about before we actually go into allocating the money. So let me make this bigger here so you guys can see. Okay, so in this example, we have stock XYZ, and it's trading at $105 per share. In this case, we're going to sell one put to open at a strike price of 100, expiring in 30 days. Okay, that makes sense. And for doing so, we're actually collecting a premium of $2 per share, or I don't like to think of it that way. I like to just think of it as we're receiving $200. So we sell to open a put at the 100 strike. So we can actually draw this out. So here's our stock. It's currently at 105. And then we're selling minus 1, the 100 put, right? And I don't know why this is so thick, but yeah, that's better. Okay, so we sold to open the 100 put. For doing so, we collected $200 in premium. Now, what are the possible scenarios that could go on here? Number one, if XYZ stock stays above 100, which is our strike price, we keep the 200 in premium and we don't have to buy any shares. So think about that compared to buying options, where if you bought the 110 call, not only would the stock have to go up, you'd have to predict the magnitude of the move plus the time frame in which that move occurs. In this case, with selling options, all you have to say to yourself is, will the stock stay above this strike price by this date? Easy. So the second scenario is that if stock XYZ falls below 100, which is our strike price, we have to buy 100 shares of stock at that strike price. So in this case, we'd have to buy 100 shares per contract at the 100 strike price. And the effective price here, we're talking about if you subtract off the $200 in a per share basis, you'd essentially be getting the stock at $98 per share. So in the case you were actually just plain out buying stock, it's actually smarter to sell a put in this case because you at least collect some premium for then being assigned the shares. Okay, so I have here, you're used when you're willing to own the stock at a lower price and want to get paid while waiting. That's very true. Okay, so this is a simple diagram and actually not so simple, because when I was learning this, these things can be unnecessarily confusing, but essentially what we see here is on the x-axis we have the stock price, and then on here we have the profit or loss. And as you can see here, this line is flat, meaning we have a maximum profit of the premium collected for selling to open that put. And then we see that as long as our stock price stays above our strike price by expiration, we collect the maximum premium. So easy enough to understand. If you guys do want more in-depth on this, like I said, just hop in here, put your email in, and I'll send you guys my cheat sheet. But let's actually talk about how to allocate this 50,000. So now that we understand what selling options are, let's actually compare it to how does it compare to buying and holding something like the SPY or the VOO? So when people talk about the market, I just pulled this off the internet. They're often referring to the S&P 500 index. So if we use that as a benchmark, the S&P over the last 60, 70 years, on average has delivered an annual return of around 10%, let's say. So let's assume for this video that our goal is to beat 10% annual returns. So on a 50K account, that equates to a roughly $5,000 profit. So given this knowledge now of these two boxes, let's actually see how are we going to allocate this 50,000 to maximize returns while still leveraging things like buy and hold, but also implement option selling strategies. So what I'm about to say might surprise you, and I'm going to say for most of you, the best idea is to allocate from the start half of the money into just holding the VOO or the SPY. Over time, this is time-tested, proven. It works, it's steady, it's consistent, it's low effort. You don't need much understanding to do it. So half your money right off the start, right into the VOO and the SPY. Preferably averaging in as the VOO or the SPY is lower. Like for example, with this whole tariff fiasco, this would be the perfect time to buy into, for example, the VOO or the SPY, because over time, this is going to double and double and double. And that money in 30, 40 years is going to be a lot. Next, I'm suggesting that we allocate $20,000 to cash secured puts. So that's things like this, where we pick a stock that we want to own and we sell to open puts on that stock, right? And these are stocks we're willing to own. And I'm going to explain how to do that here. But for the sake of this part of the video, we'll move on to the next thing, which is the last $5,000 we're going to allocate to spreads, whether it be credit spreads or debit spreads, as well as iron condors. So if we see here, and by the way, these require very low buying power, but they produce a lot of extra cash, potentially. So the breakdown here would be 25,000 into the SPY and VU, 40% or 20,000 into cash secured puts of stocks you're willing to own long term, and then 10% into spreads and condors. So why do I suggest this? So buying and holding the VU or the SPY is safe long term, and it generates consistent returns over time, as we've seen. Selling cash secured puts on stocks we want to own allows us to take advantage of volatility and large moves, which bring in higher option premium and juices the otherwise 10% return that we can expect from just simply holding the SPY and the VU. So it allows us to place kind of like targeted bets on stocks we're willing to own and collect premium for doing so. Number 3, the spreads and condors are going to generate a nice amount of extra income without tying up hardly any buying power. So we can typically, for me, I use these on higher risk stocks that we may not be comfortable owning. And the reason for this is because spreads are limited risk, limited reward. They don't require me to have the risk of capital sitting on the sidelines that might get used up to buy stock. And we can take advantage of contextual trades like earnings or news, things like that, without having to tie up thousands or tens of thousands in capital. So let's now connect this right here, this 20,000 in cash secured puts, and see how you can trade what's called the wheel strategy with this $20,000. Let me take a drink here, but this chart is very helpful. Okay, so how to trade the wheel with $20,000. If you're not familiar with what the wheel strategy is, I'll briefly outline it here. So the first step is selling an out-of-the-money cash secured put. So in this case, it would look like this. We have a stock that's moving like this, and say it's at 105. Selling an out-of-the-money cash secured put would be doing this, -1 of the 100 put, right? For doing so, we collect a premium. We already went over this. If the stock stays above our strike price by expiration, that put option is going to expire worthless, and we're going to keep that premium we got for entering the trade. If the stock drops below the strike price by expiration, that short put is going to be assigned, and we're going to have to buy 100 shares of stock at our strike price. However, we still keep the premium, which then lowers our cost basis. Once we're then assigned those shares, we can do what's called selling an out-of-the-money covered call, which generates even more option premium income to us, and then we can potentially flip that stock for a higher price if the call option that we write is higher than where the price that we own the stock at. So in this way, we can just basically cycle through this. It's called the wheel. Like I said, if you want more information and want to go through this more in depth, click the link to get my cheat sheet. But how do we actually pick stocks for the wheel? So with a 50K account, you need to be careful, right? Because for me, I trade on a larger account. I can stomach holding some of these riskier stocks. But for you guys with a 50K account, you need to be very particular. And I'm going to emphasize this number 1 here very strongly, which is always start by asking yourself this question. Am I willing to own X stock at Y price? So for example, am I willing to own AMD at $100 per share? So in the event that assignment were to happen, right? So in the event that this were to occur, where the stock drops below your strike price, you need to be willing to own the stock at that price. So step 2 is kind of like what I like to say, is the juice worth the squeeze? Meaning, is the option premium collected relative to the amount of capital that we need to output to own those shares worth the return? So let me give you guys this equation here, and this is really not, there's a more formal equation, but I'm just using this for the sake of the video, and it's simple. You take the option premium you collected divided by the capital required if you were to be assigned the stock, times 100 to get it into a percentage, and then times 12 to make it, in the case that we were looking this over 12 months. So if we were to do this once a month times 12. Okay, so let's give an example here of what I mean. So I took this right off the option chain. Say I sold to open the AMD 85 put for $1.50, right? So let's go through the equation. $150 is the premium I collected. Then I divide this by the capital required if I were to be assigned the stock, right? So 85 times 100 shares times 100 times 12 to get the annualized return of 21.2%. And as you can see, if you answer the question yes to am I willing to own AMD at this price, you now just took a trade that generated, if you were to take this every month, 21% over the course of the year, which substantially juices our goal of beating the 10%, right? So we already have half, right, just sitting in the VOO and the SPY. But now we also have a double percentage generating machine here, which is selling the cash secured put, right? So this clearly outperforms the 10% benchmark. However, at some point, as some people like to say, picking up nickels in front of a steamroller, you will get assigned shares, which is why step one is crucial, right? You need to be willing to own this long term in the event that all of a sudden the tariffs come back and the stock is now at 60 and you own it at 90. Well, you better be willing to own it long term. So very briefly, I make a ton of other videos. And like I said, my cheat sheet explains this. How do you actually choose a strike price? For the wheel strategy, I'm typically choosing between a 20 and 30 delta out of the money, which is roughly 70 to 80% probability. And I'm choosing 30 to 45 DTE. There's a lot of research on why this works. I won't go into it in this video. And briefly, how do we actually monitor for stocks that would fit this criteria? Well, we first simply set up a watch list of stocks you want to own, then monitor for large downward moves in those stocks. So then you can then sell cash secured puts to not only capitalize on volatility, which means option premium is higher for the option seller, but also take advantage of getting that stock at a discounted price from this downward move. Okay, so at this point, if you're confused, that's okay. I make a ton of other content on this, but if you are familiar with these strategies, you should be able to follow along quite well. So the last thing, which is kind of an interesting and probably the most exciting part of this, is how are we going to take 5,000 or only 10% of our capital to generate a substantial amount of yearly return? And that's through the strategy of spreads, whether it be credit, debit, or credit spreads, and iron condors. Now, there's other things like butterflies, etc., that for the simplicity of this video, I'm just not going to include. But let's talk about a simple spread. So when to use a spread. And if you're not familiar with credit spreads, please watch my other videos on this, because if you are a complete newbie, these are a little bit confusing to understand. So we want to implement a spread when you want to trade a stock that you are not comfortable owning, so it doesn't fit the cash secured put criteria, or one that is too expensive to trade the wheel on. So for example, you might like something like, Goldman Sachs, the ticker GS. But with a 50K account, you can't necessarily trade short puts on it because you don't have enough capital to actually own the stock, but you can trade spreads on that, right? So in the case, this is just some simple criteria here to follow, and there's a lot more. This goes into a lot more depth in other videos, but typically in high IV environments, you want to use a credit spread, and in low IV environments, you want to use a debit spread. So for me, I kind of use spreads as a low risk way to bet directional moves. They require a low buying power, and they can easily juice your monthly returns without tying up much capital. So let's go through an example. In this case, I'm using AMD again. You can see here it's trading on this chart around 90. And let me change colors here. So it's trading around 90. And what I did here is I just drew up a hypothetical trade, which is a call debit spread, which is the 86 and 87 call. So in this case, we would be buying the 87 call and selling. Actually, wait. Okay, no, sorry. It's the 86, 87. So let me erase this. and change my color here. So we're buying the 86 call and selling the 87 call. And as long as AMD then goes below or above 87 by expiration on April 25, you can see here we have a situation where we have a max profit and a max loss. So our max profit here is $490. Our max loss is $510 with a buying power effect of only $523. So this is a great way to make a directional bet on a stock where we only have to tie up $523 in buying power, but we have a possible max profit of $490. If you just were to do this once a month, that's $5,880 profit using almost no buying power. That alone surpasses the 10% that we mentioned as our goal. Now, the caveat here is you're going to lose some of these, right? In fact, you're going to lose maybe half of them, or in some years, maybe 3/4 of them. But in some years, you might win 75% of them. So this is really, you want to use spreads when you're very confident on a directional bet, and you want to use these to supplement your income that you're generating from these other methods without tying up a lot of buying power and juicing up kind of like, the money you're making from these other things. So if that video was helpful and you guys want to see more long form breakdowns of different account sizes using option selling strategies, click the subscribe button, leave a comment if you have any questions, and don't forget to pop your email in here. I'm sending you guys my option selling cheat sheet for free that breaks down these strategies in more depth. Anyway, I hope you guys enjoyed that video, and I will see you in the next one. Peace.